This is Nick Lepetsky and Jake Chapman with Amplifi, and we're going to talk some more about how money works in business. And today we're going to talk about sources of capital or sources of funding, but specifically, how do we make decisions around what funding and what capital to use in our business? One question, is it better to borrow or give up equity? That's something we run into quite often. This is Jake's world. And so, Jake, when you're working with a client or you're working with a business that's pondering what to do with outside capital, should they use outside capital? What kind of capital? I think this is a conversation more about how does a business owner make a decision, right? Less about should or shouldn't they. But what do you think? What do you usually do with our clients when they come to this crossroads?
Yeah. So I think the first thing that comes to mind is that to understand where you can get capital, and then how you evaluate what you're going to do with it, and then that can help determine, raising outside capital. A lot of times when people refer to sources of capital, they're talking about equity. They're talking about raising around, bringing in more shareholders. That is obviously one source, but there's four primary sources of capital, there's four sources of capital. There's cash flow from existing operations. So your net income at the end of the year generates, something that you can use to invest. You can sell assets. So, in a manufacturing company, for instance, you could sell off some, part of the business or something like that. You can issue equity, which is what a lot of people are often talking about, or you can go find a debt provider. And so, when we look at that, we have to say, what do we want to accomplish with this? What's the return on equity of that? And then is it worth, splitting up the pie to grow the value of the shares, right? So essentially, if you own it 100%, you split it with one other person, that transaction needs to generate, double the valuation to get you back to where you were. And a lot of times I don't think people think about that. They think about, well, we need cash to grow. But what is the actual return for the existing shareholders based on what you plan to do with that cash? That's the big question mark. And so, the equity issuance and the debt borrowing from a bank or from a debt provider, those are both sources of capital. If you understand what value you're trying to drive to existing shareholders, it does make that question, easier. So it's not exactly easy to quantify what value you're driving, but you get through that exercise to say, like, this is the activity that we want to do with the capital, and we think it's going to generate this, and therefore increase in valuation, theoretical increase in valuation of this, and we're confident in that projection. And you should measure that against the cost of the debt, right? So and versus the cost of the equity. What happens if you could raise the money on debt, pay 6, 10%, whatever it is, and also still accomplish that? Was it worth giving up that much equity, right? So there's this kind of like there's this evaluation that has to happen with whether or not your existing shareholders are going to grow the value, right, of their shares by taking on additional shareholders. Split up the pie. The pie needs to get bigger. At what rate it gets bigger is the important question.
Bigger pie.
Yeah.
Sounds good.
Yeah.
All right. Well, maybe next time we'll talk too about how do we figure that out? Like, what do we do to make sure, we're calculating that our pie isn't going to end up bigger. But
yeah, I think a lot of times, you have a pre-money valuation, you have a post-money valuation. Nobody really splits out their pro rata share and says, like, I just raised a round. Is that capital going to be allocated correctly to growing us back to a portion, to a pro rata portion of the valuation that is, above what it was? I think everybody kind of just says intuitively, if I get more money, I make more money, right? But like, not equity issuances are not always a good idea. And if you have an alternative, like a debt, if you can finance this with debt smartly, and not not kind of just taking on credit cards, but really understanding how to fund it. You can you can keep the whole pie and then pay down the debt. So yeah.